Good day, ladies and gentlemen, and welcome to our multi-asset update. It's a quarterly update that we do, and this is the fourth quarter of 2020, where we're having a look at zooming into the last 3 months of the year, and then zooming out to the calendar year that was 2020, a year that will go down in history as the year of Corona and the year of uncertainty in our markets. If we start and have a look at the big picture, the beginning of Q4 was overshadowed by global Corona cases exceeding 85 million, coming from 35 million at the end of Q3. So, very fast ramp up in Corona cases. Also, a lot of uncertainty in the beginning of the quarter around the US elections. However, what was a shaky beginning to the fourth quarter ended strong, with strong equity markets, strong property markets, a strong risk on, and a lot of optimism in the market, based on the back of some certainty around the US elections, with a Biden win, combined with some planning and optimism around a speedy COVID-19 vaccine rollout in the developed world. In the South African market, we saw Corona cases exceeding 1 million, that coming off a base of 650,000 cases at the end of Q3, and we saw the economy tightening up with further restrictions coming into the fall in December. Notwithstanding the Corona cases uptick and the tightening of the economy, we saw very strong equity and property markets in the last quarter of 2020. So I have no doubt a massive relief to most investors that the asset class returns ended on a very strong note. Having a look at the funds, wealth accumulation over the last quarter returned 6.95%. Most of this return being driven out of the equity buckets, and also very strong property returns of 12.8%, the standout asset class for the last quarter, however, coming off an extremely low base. So calendar year 2020 returns of the listed property market around negative 38%. And so, the 12% was a welcome relief, but not nearly enough to recover the capital losses of 2020. It's fair to say still a lot of uncertainty in the asset class, a number of big REITs being questioned as regards to their REIT status, not to mention the fundamental underpin and the sustainability of some of the distributions that forecasts in that asset class. So we had a strong fourth quarter. Zoom out to the calendar year return, and we had a total return of just over 5% for the year of 2020. Notwithstanding extreme sell-offs in the property market, as I mentioned, property market down 38% over the year, benign equity returns, but we had strong performance from foreign equity and foreign bonds, which drove the majority of the returns in the portfolio. So notwithstanding some of the large sell-offs in the beginning of the year, we saw all of that capital recouped, and in fact positive returns for the calendar year. If we have a look at the Stable Income Fund, the quarterly returns, also extremely strong quarter end closeout. We saw equities driving returns again, and listed property, followed by local bonds, where we've got a healthy position of close to 16% weight to the local bonds and local credits. So 6.74% return for the quarter, with some detraction in return from foreign property and bonds. However, on the back of Rand strengthening about 12% over the quarter, so the asset classes themselves and their base currencies and hard currency actually did not depreciate or did not pull back over the quarter. It was as a function of the Rand strength. The Rand strength, again, as I mentioned, a risk on appetite globally, with optimism around the COVID vaccine, with certainty in the US. We saw emerging markets run into the end of the last quarter, and the Rand being a benefactor of some capital flows into our market, both our bond market and our equity markets. Zoom out, and benign returns for the calendar year of 2020 from Stable Income. However, it certainly wasn't benign activity, extremely volatile year. The fund did draw down through the year quite significantly in April, but again, recovered all of that, recouped all of that capital loss. Very, very shortly thereafter, we've got some graphics to have a look at later, and the return over the 2020 year was a positive 2.57, It's worth noting that the distributions over the year of 2020, net of fees, were north of 5%, showing some of the income underpin that is exhibited within this portfolio, and extremely important for the goal of the portfolio being an income goal with sufficient growth, so sufficient exposure to our risky assets. Largest detractor to this portfolio, similar to wealth accumulation, being listed property, where we have a 7.5% weight in listed property and a large sell-off over the year of 2020, with uncertainty around the asset class and around some of the structural challenges that it faces. Foreign equity and foreign bonds driving the lion's share of returns, closely followed by SA bonds and short duration credit, which contributed fantastically to the return profile and the diversification profile of the portfolio. If we look at the Corona coaster of 2020 and look at the two funds, wealth accumulation in red, stable income in blue, we saw drastic drawdown events in March through to April. But what this graph really shows is that the investors, who sat on their hands, so to speak, the investors who stayed the course, were rewarded and their capital recovered extremely quickly. In fact, within 3 months, most of the capital had been recouped that was lost in April and May. So the investors who stayed the course, the investors who stuck to their long-term goals, were rewarded in terms of the recoupment of capital. Interesting side note, there was a lot of talk about cash in the first quarter of 2020 and the second quarter of 2020. Had an investor moved into cash at the bottom of the wealth accumulation drawdown before tax, it would have taken them at least 5 years to recoup the capital. So just to get back to that 100 point or that base of 100 in stable income, it would have taken them slightly less, 4 years. That's on a pre-tax basis. So on a post-tax basis, you can gross that up by roughly 50%. So say 6 to 8 years to actually recoup your capital after tax if you had moved into cash after the drawdown event in those individual funds. That compared with the wealth accumulations and stable income recovery, which was roughly 3 months post the drawdown. So it just goes to show that one needs to stay invested and see through the volatility of risky asset classes, and you can be invested. It also goes to show that the speed of the recovery is such that you cannot afford to be out of the market for any period of time. Another thing we want to have a look at is the benefits of diversification. So in our global equity bucket, we use both developed markets and emerging markets. And October, the period where there was gross market uncertainty, we saw a disconnect between developed markets and emerging markets. Now, this kind of disconnect is exactly what we're looking to leverage when we're holding them, both developed and emerging markets, in our global equity bucket. So it really shows the benefit of holding both EM and DM, and the return benefit of seeking that alternative source of return from emerging markets. It is fair to say that developed markets have driven global equity returns over the last 5 to 10 years. However, if we roll back further, there is certainly alternative sources of return from the emerging markets that will come to the fore over different period of times and in different market conditions. So the last thing we wanted to have a look at was a kind of a flashback from one of our previous quarterly updates, where we looked at the importance of diversification and the challenges of predicting next year's asset class winner. And this year was no different. So 2020, if I told the average investor at the end of 2019, 2020, we're going to see a global financial crisis, most people would say we're looking for safe haven assets. We're going into global sovereign bonds. We're going into cash. However, 2020 saw the riskiest asset class, equity, global equity, showing the best returns. That followed by global bonds and then SA bonds and SA equity. So, cash, which would typically be king in a global financial crisis, actually ranked quite poorly on the asset class characteristic scale, or the asset class calendar year returns. It just goes to show how difficult it is to predict what's going to happen in the markets. And even if you could, it's extremely difficult to predict how asset classes will return and behave themselves. And thank you for your investment over the year. It's been a tough year. We hope that 2021 is going to be a better year, that we're going to see a return to normalcy, both in our personal lives and in global markets and in asset and capital markets. So thank you for your time. Just to recap, when we look at approaching an investment problem like creating wealth or accumulating wealth, we look at controlling the controllables. It's been a year of many uncontrollables. It's been a year with a lot of speculation around vaccinations, around COVID, etc. What we look to do is dial down the noise, focus in on strategic asset allocation, ensure our portfolios are well diversified, and ensure that fees are kept low. So thank you for your time. If you have any questions, please don't hesitate to ask, and we'll sure to be in touch. Thank you very much.